the near-term disruptions that will be caused by GST will have some impact on the corporate earnings. But we feel that some sectors could see a much longer term impact, such as property and property related sectors like housing, finance, etc. But consumer staples should be a sector that should see the least impact, and possibly the negative impact should probably get over in a quarter or a few months or so. So having said that, we feel that now the stage is also now set for more rate cuts, and this time we feel that the transmission of any potential rate cuts by the RBI will be transmitted by the banks much faster than what we have seen in the past. The reason being that we feel that in the initial phase of the demonetization scheme, there will be a big bump up in the bank deposits of around 8 to 10%. Some of that might get withdrawn, but on a more durable basis, we still expect a 4 to 5% increase in the overall deposit base. With credit growth not showing signs of pickup just as yet, a lot of that will likely get invested in the bonds, in the government bonds. So that's a good news for the government bond yields as well, which should head south from here. So that makes India a very unique market, that globally we are seeing the bond yields rising across the board, but India could perhaps one of the only countries or the major economies that could sort of buck that trend. And it would also mean that the banks will have enough liquidity to cut their own lending rates and deposit rates for a potential faster transmission. The key sort of risk, however, remains the weak trend in the capex cycle. Despite the government efforts towards reviving that, the government is trying its best to revive the road sector and the other infra capex, but the private sector capex continues to be quite weak. We do not feel that the private corporate capex is going to show signs of pickup over the next 1 to 2 years, because the capacity utilization rates are still low for key manufacturing sector industries such as steel, cement, also for power generation, where the rates are between 60 to 70%. So that leaves us with the household sector capex, which is largely into property. And while we were seeing some signs of stabilization coming back into the property sector, but now I feel that with the recent measures announced, the sector recovery gets postponed, at least by a year or so. So that makes us, more cautious on the investment cycle plays, and we will therefore be more constructive, on the consumer side, on the commodity side. Our top sort of sectors where we have an overweight position is private sector banks, over NBFCs. So our clear preference is for banks, and not NBFCs. We also run an overweight position on consumer staples. We also have an overweight, on the global commodities, including petrochemicals, metals, etc. And we have an underweight on industrials, IT, and telecom. So this is just a quick brief from my side. If there are any questions, I'll be happy to take those.
My question is, you mentioned about the near-term pain. How much is the earnings downgrade that you expect from the demonetization? And also, you said that there will be some mid-term impact. So, any impact you expect on NPL cycle recovery that we were expecting? Is there any change from that?
Yeah, so on the earnings, growth front, the current consensus expectations, are around 16-17% earnings growth for the current financial year, and a slightly higher 18-19% earnings growth for the next financial year, FY18. We feel that the earnings growth estimates will need to be revised downwards by approximately 4 to 5 percentage points. So we should still be in double digits, so more like 10 to 12% for this year. And still more than 15% next year. This is still much better than what we have seen in the last 4 years. But clearly the pace of improvement will now have to be moderated downwards. But as I said, it's more near term, in the nature.
Mahesh, hi, this is Chetan from NDTV. So you just spoke about the road sector, and you also mentioned that there's a weak capacity utilization with respect to the capex of private companies. So can you focus on the fact that when you see a recovery in the road sector, considering the government is literally boasted on the fact that they are building 22 kilometers of roads per day. So what is your uptake on the road sector particularly?
No, so the road sector, we have clearly seen a big revival. And there are various indicators that show that. So not just your interactions with the road sector developers, and that, but even when you speak to the cement manufacturers, for example, they tell you that the growth is really picking up because a lot of these new roads have are heavy on structures which require cement. Also we've seen the demand for things like bitumen, etc., which is required in the last stage of the road, that's picking up. So there is no confusion in our mind that the road sector is not doing it. It is clearly one of the few infrastructure segments we have seen a very good pickup.
This is Manvi from NDTV. I want to steer you back towards the impact that you see on the NPL cycle for the banking sector in light of the demonetisation moves, given that you're also overweight in banks.
Yeah, so the thing is, the NPL cycle will face some incremental pressures, on the back of this. I feel that the impact will be limited more to the SME segment or the banks that have exposure or more exposure to the SME segment. So that segment, will come under some sort of a pressure. I think, there will be some pressure on the NBFC side as well. So the banks that have more exposure to the NBFC segment, could be, a bit of a question. But I don't want to generalize that because, then a lot depends, on specific accounts and, a lot depends on, your own internal credit assessment procedures, etc. But yes, but by and large, I would say that the NPL cycle problems worsen a little bit, on the back of this announcement.
And it's tough to estimate for how long they worsen before they get better?
Well, difficult to say, but as I said, in the beginning, the impact should be more near term. So as I said, except for, the property and property related sectors, I would not expect a negative impact of, say, more than a couple of quarters.
Could one argue, and I'm sorry for arguing the questions, that there could be a near-term negative impact on some of the consumer sectors as well, depending on how the liquidity crunch plays out?
Yes, definitely. So consumer durables, should see bigger impact because a lot of these items are more discretionary in nature, and you can easily postpone the purchase of, a car, or you can decide to, postpone the decision to, let's say, paint your house or whatever. So I think some of these discretionary consumer items will see a bigger impact. Not so much for staples, because staples is something that you need anyway. So that should see a very limited near-term impact.
Mahesh, this is Mahesh from CLSA TV. You have a FY18 earnings expectations of 15%. Given the recent developments, is there for a risk for a downside? And given that, have you to change the December 17 Sensex and Nifty targets?
No, so as of now, the current bottom-up expectations for FY17, FY18, as I said, is about 16% and 18%. The new numbers will be more like 10 to 12 for this year and 15 for the next year. So the 15% number that I'm giving you is taking into account the possible earnings downgrades that might happen going forward.
So at a 15% earnings growth, given the way the markets are, is there a risk to the Sensex targets as well for FY17, or do you think it's still manageable and there will be a bump in the second half of this year and maybe the first quarter of next year?
See, the market, will be a function of multiple local and global factors as well. So let's not, forget the global factors as well, because more often than not, big movements in the markets are driven by global factors and not local factors. So we also have to see what's the change that happens in the global risk off sentiments. As of now, we are clearly seeing the bond yields all across the world are going up, so that's clearly a risk off event. So that's also something that we have to keep in mind. But yes, but if you just focus just merely on the local factors, I personally feel that while there will be an earnings downgrade because of these factors, but most of the international investors, most of the global long-term investors will most likely look through this near-term weakness because here is one country which is probably taking all the right steps for the long-term structural improvement. I mean, not just a big taxation reform like GST and what has been announced last week, but also things like making banks account for the NPAs and provide for it. rather than some other emerging market economies where the advice of the banks is keep sort of evergreening, etc., and therefore report lower NPAs. So with such strong structural tailwinds behind, I feel most of the long-term investors will be looking through this.
I'm fascinated by the consumption story, so bear with me. I mean, if I put this proposition to you that migrant wages could be under pressure given the demonetization, the impact on FMCG therefore coming from that, another pressure point on FMCG consumption could be just the supply chain. Any reflections on that that you've arrived at?
No, so as I mentioned before, the cash crunch related impact, like you have money in bank, but you don't have enough to buy, let's say, a bottle of shampoo, or you have money in bank, but you can't pay wages, to your laborers, or the distributors or the retailers not able to stock enough because of cash. So I think these are cash availability related issues, not really demand related issues, as such. So I think the supply related issues should get addressed maybe in a month or two, I guess. So I'm not too much worried on that, and that's the reason why we have an overweight on the staple side, because that's the segment which will see the least impact. Everybody gets impacted, so we are just debating about who gets impacted the least and who gets impacted the most.
Mahesh, you mentioned that the deposits will increase, you expect an increase in deposits in the banks, but at the same time you are saying that capex is not picking up. Do you think that will also put pressure on banks' earnings in the medium term? And will the private banks will be safe, as you said that you are overweight private banks? Will that be because of the consumption credit demand, consumer credit demand or retail credit demand that you're expecting? Will that how you see panning out? And another question is that with India moving to cashless economy now, do you think e-commerce is something that can come up as a big investor fancy sector?
Yeah, so your first question on credit growth side. So credit growth is already weak, at this point in time. So there is, reasonably good retail demand. But if you look at the investment demand, then only one segment of investment, which is the government spending, which is quite robust. But the private, corporate and the household sector has been weak. Now, the expectation was that maybe there is some pickup on the corporate capex side or on the property side going forward. So probably that gets sort of pushed out a little bit, with this. So I don't think there is going to be a further deterioration in the credit growth. It's just that the expected pickup now gets pushed out. So, I'm not really worried, on that part. To your question, on the impact on the bank earning, the thing is, I feel that most of this incremental deposits, and I mentioned about 4 to 5% of incremental deposits on a more sustainable basis, most likely this will come under CASA. So the cost of deposits is likely to be maybe 4 to 5%. And even if the credit growth does not pick up, even if the banks, invest in government securities, you're still making a 2% kind of a spread, on that. So this should be a positive for the bank earnings. But as I said, the economic slowdown, on an overall basis, will be a much bigger factor, at least in the near term. So I don't see the possibility of an earnings upgrade for the banks, despite this incremental spread that I spoke about, because there is offsetting impact on the overall economic slowdown and some possible increase in the asset quality pressures as well.
And e-commerce?
Yeah, e-commerce. So clearly, I think the e-commerce companies would be smiling, especially the e-wallet, etc. Although to the extent that a lot of e-commerce companies derive their business on COD, and that segment could still get impacted. But I think some of the payment wallets companies would really be very happy with these developments.
Mahesh, you've made some changes to the model portfolio as well of late. Can you just run through those? And specifically because you just mentioned about pharma, what's the view for CLSA at this point in time on the Indian pharma company?
So, I'll not be able to comment on specific stock-related changes, but at a more broader level, as I mentioned before, we are worried about the property and property-related sectors, including housing finance. So, in our portfolio, we have reduced weight for housing finance sector, and we have added weight to consumer staples. We've added weight to healthcare names as well, because some of the stocks have corrected quite a bit. and also the fact that Clinton hasn't won the elections, so it also gives a bit of a relief to the pharma sector in India, and we've also been adding commodities.
I wanted to ask about the commodities because that's a bit of a, in fact, the metal index last year has been a big outperformer, and it's been a bit of a surprise for most of the investors. You think this momentum in the global commodities and so to speak for Indian metal companies is going to continue at least in the near term?
We feel so because we feel that the U.S. economic growth outlook today is better than what it was before, on the expectations that there will be some fiscal boost. In the U.S. we are expecting a 500 billion plus kind of a fiscal boost going forward, which should be positive for the commodities demand. We also giving benefit of doubt on the China demand side as well. So yes, we do feel that the outlook for commodities look reasonably good, and the Indians stock valuation also appears to be reasonable, despite the fact that many stocks have actually doubled over the last 12 months.
One final, I just wanted to get your thoughts on, is the stage firmly set now for the RBI to cut rates?
Yeah, we believe so. I would say that the possibility of rate cuts have increased considerably over the last 1 week or so with the events that we've seen. Our forecast is that over the next 12 months we should see about 50 to 75 basis points of repo rate cut by the RBI. All right, thank you very much everyone for your time. Thanks a lot.
And thank you.